Hey traders, and welcome back to another episode of Trade Like Assad. Imagine being able to anticipate where price is likely headed by tapping into the unseen forces of liquidity and fair value gaps. It's like possessing a blueprint for market momentum, a blueprint we're about to lay out right in front of you. In this advanced session, we're taking a closer look at the complex interplay between internal and external liquidity, showing how price seeks and reacts between them while simultaneously addressing the gaps that bring balance to the market. Whether you're an experienced trader or new to the game, grasping this concept can offer a sharper view of price behavior and possibly improve your trading performance. So stay with us, because we're about to take you on a path that might transform how you engage with the financial markets. So traders, if that sounds valuable, don't forget to hit the like button to support us and subscribe to our channel if you haven't already. We'll see you right after the intro and disclaimer. Welcome back traders. So let's dive straight into the concept of drawing on liquidity. Drawing on liquidity means forecasting probable price movement based on the presence of liquidity and fair value gaps. It's one of the most essential elements in trading that you must thoroughly understand before executing any trade. It enables you to anticipate the potential path price might take and the kind of price action behavior to expect, such as where price may pull back before continuing in an upward or downward direction. What drives market price movement? The mechanics behind market shifts can be attributed to two fundamental components that regularly impact price flow. First, liquidity zones. The market constantly attempts to tap into areas of liquidity to fuel momentum. In simple terms, liquidity is the driving force behind the market's activity, playing a crucial role in shaping its structure and behavior. We've previously explained how to pinpoint liquidity zones effectively. The second key element is fair value gaps. The market often exhibits a tendency to rebalance inefficiencies by filling those gaps. If you examine this case, you'll see that price made a sharp move downward, creating inefficiency and forming a fair value gap. Afterward, price climbed back up to fill the gap and extended higher to reach external liquidity. Once that liquidity was absorbed, price then shifted downward again to revisit and fill the nearest fair value gap. This repeating cycle illustrates the market's mechanism, where price works to clear out liquidity while also resolving fair value gaps. Let's now quickly review what fair value gaps are and how we can recognize them during live market conditions. Fair value gaps generally appear within a sequence of 3 candles and are easily visible on the chart. As a dominant candle, the key characteristic is that the wicks of the candles on either side don't entirely intersect with the body of the middle candle. This forms what's known as the fair value gap zone, which occupies the area between the wicks and is based on the body of the impulsive candle. Consider a scenario where the price drops significantly. In this instance, a fair value gap or liquidity gap is formed due to the lack of buying interest during that specific leg down. Identifying fair value gaps relies on a particular approach. The gap is spotted by examining just the impulse candle, whether moving up or down, along with its immediate neighbors. Candles beyond this 3-candle formation are irrelevant when detecting the gap. These zones of thin liquidity are highly relevant, as they often act as strong areas for trade entry, since price tends to gravitate toward liquidity in a downtrend. For example, price targets liquidity zones overhead before reversing and filling the nearby fair value gap. This movement sets the stage for the price to resume its downward path with increased momentum. Now let's transition to the upcoming subject, internal and external liquidity. But prior to exploring those in depth, it's vital to emphasize one essential phase in your trading evolution: back-testing your strategies before applying any strategy or setup in a live environment. It's advisable to backtest it no less than 100 times. Multiple variables, including market behavior, trader mindset, trading sessions, risk approach, and time frame, all impact a strategy's overall success rate. Now, when discussing liquidity, we break it down into 2 primary categories: internal and external liquidity. To better understand this concept, let's visualize a market structure resembling a rally wave, which includes a prominent high and low. These swing points indicate external liquidity. In simple terms, external liquidity is defined by the key highs and lows formed during the rally wave. Conversely, the fair value gaps that occur within the span between that high and low are identified as internal liquidity. It's crucial to remember that when analyzing a lower time frame chart, you'll observe multiple internal highs and lows as well as different structural patterns, but when you shift your perspective to a higher time frame, all of those details are interpreted as fair value gaps. Price action in the market is constantly shifting between two types of liquidity, internal and external. Envision it as a continuous loop where price alternates from internal to external liquidity or from external to internal liquidity. Put simply, price either moves from a significant high or low toward a fair value gap or transitions from a fair value gap back toward a key swing high or low. This represents the core movement behavior the market tends to exhibit. Looking at this schematic example, we see an upward rally wave where price first targets and sweeps external liquidity resting above a prior high. Once this liquidity is taken out, price begins to move toward internal liquidity identified by a fair value gap to correct the inefficiencies created during that leg. The market then resumes its focus on external liquidity. In this phase, price travels from the fair value gap to target external liquidity by breaking above the recent high. After external liquidity has been taken, price looks to rebalance once more by shifting its direction toward internal liquidity. As a result, price declines to fill the most recent fair value gap. After this gap is filled, the next likely move is toward external liquidity. The question now becomes whether price will push toward upper external liquidity or fall toward lower external liquidity. To answer that, it's important to assess the previous order flow from a higher time frame or within the current time frame. For example, if zooming out reveals that the overall structure is bearish, you would expect a break lower, meaning price is more inclined to reach for lower external liquidity. Alternatively, if the broader trend is bullish, the assumption is that price will continue upward in search of the upper external liquidity. Another key element we can use to assess the likely direction of price is the behavior it displays upon entering a fair value gap. If the price respects the fair value gap and shows a strong rejection to the upside, this signals that price is likely to pursue the upper external liquidity. On the other hand, if the price fails to show a meaningful reaction when reaching the fair value gaps, it implies that price action is more inclined to move lower in an effort to tap into the external liquidity resting beneath the low. Now let's switch over to the live chart and walk through some real examples. Here we have the euro-dollar daily time frame chart displayed on the screen. Let's analyze this bullish rally wave. We can observe that price initially dipped below the low, triggering a sweep of the external liquidity resting beneath that level. After this move, price began retracing upward toward internal liquidity with the objective of filling the fair value gaps. Once this rebalancing was complete, price shifted direction again and declined to target the external liquidity. Next, in this area, we can identify a bearish rally wave that has already taken out the external liquidity tied to the previous rally's low. From here, price started moving in the direction of internal liquidity. Now we see price making its way toward internal liquidity, specifically targeting the fair value gaps and showing a reversal upon reaching the extreme end of the gap. Further along, we witness yet another rally forming on the chart where price initially cleared the external liquidity in this region. After that move, price demonstrated a strong bullish push aiming at these three fair value gaps, but it's clear that price did not respect any of those levels. Although the fair value gaps were rebalanced, price did not reverse to the downside. Instead, it continued upward to pursue the upper external liquidity. What's clear here is that after sweeping the buy-side liquidity and forming a clean PI, the price promptly shifted back in alignment with its prevailing direction. It's important to recognize that price now appears set to target the buy-side liquidity. This highlights a strong underlying reason behind the move. The buy-side liquidity has already been cleared and price is now targeting the sell-side liquidity, which is consistent with the dominant market trend. This high-probability setup is definitely one of my personal favorites and has been a key component in my trading plan. I'm also excited to let you know that I'll be dedicating an entire tutorial on this strategy in one of our upcoming episodes, so for those of you watching, be sure to stay connected for that valuable insight. Your ongoing support and engagement are truly appreciated, and I look forward to exploring this concept with you in greater detail soon. Moving forward, you can see that price made a strong bearish move, clearing the low from the previous wave, which represents external liquidity. After that, price retraced upward toward internal liquidity, targeting and rebalancing the nearby fair value gaps. Once those gaps were addressed, price continued with another leg toward external liquidity as shown here. Similar to the previous setup, price swept that external liquidity with a long wick and then moved upward to fill the nearby fair value gap. However, as observed, the price eventually reversed after this move and resumed its bearish trajectory. That wraps it up, traders. Always remember that trading isn't solely about chasing profits. It's equally about managing your risk effectively and maintaining discipline. Success in trading doesn't come overnight. It requires patience, consistent practice, and a willingness to grow through experience. Don't let setbacks discourage you. Stay committed to learning and refining your strategies. Stay focused and keep pushing forward. I wish you the very best on your trading journey. Thank you for tuning into this video. I hope you found this content insightful and valuable. If you did, make sure to subscribe to the channel and enable notifications so you never miss our latest uploads. We genuinely welcome your thoughts and ideas, so feel free to share your comments below, and let us know which topics you'd like us to explore in upcoming videos. Thank you for your continued support, and we look forward to having you with us in the next episode.